Most people believe you need thousands of dollars to start investing. They think it's a game reserved for the wealthy or the experts in suits on television. But what if I told you that the most important factor in building wealth isn't the size of your bank account, but the speed at which you start? Today, we are going to tear down the walls of entry. I am going to take $100, a sum most of us spend on a single weekend of takeout, and I am going to show you exactly how to turn it into a powerhouse for your future. This isn't just about picking a random stock and hoping for the best. This is about understanding the mechanics of money. We are going to test 5 distinct financial vehicles, ranging from traditional assets to the high-risk, high-reward digital frontiers. By the end of this video, you won't just have a list of ideas, you will have a clear, step-by-step roadmap for your financial freedom. But we have to be real, most people lose money because they lack a system. They chase trends, they panic during market dips, and they ignore the fundamentals of taxes and risk management. Today, we change that. I am going to use a simple grid to judge each method. We are looking at the learning curve, how much passive income you can expect, tax efficiency, and the cold, hard reality of risk. It has time to move from being a spectator in the economy to being an owner. Are you ready to see where your $100 goes? Let us begin. Before we throw our money into the market, we need a standard for judging these investments. Most beginners treat the stock market like a casino. They toss a coin and pray for a win. That is not investing, that is gambling. To build lasting wealth, we need a framework. Look at this grid. This is how we are going to grade every single investment we test today. First, we have the learning curve. How much time do you actually need to spend studying before you can make a decision? We want to avoid paths that require you to become a full-time professional trader. Second, we are looking at passive income potential. Can this asset pay you while you sleep? Or are you forced to sell it just to see a profit? We want machines that print money, not assets that just sit there collecting dust. Third, we look at tax efficiency. This is the secret weapon of the wealthy. It is not about how much money you make, it is about how much money you get to keep after the government takes its share. If you are ignoring taxes, you are essentially throwing away a huge portion of your potential gains. Finally, we address the risk level. This is the heartbeat of your portfolio. We are going to be painfully honest about what happens when things go wrong, because eventually, the market will correct itself. If you aren't prepared for that moment, you will panic, you will sell, and you will lose everything. This grid is the difference between an amateur and a pro. Stop guessing. Start calculating. Now that we have our rules, let us see which of these 5 paths deserves your hard-earned $100. The first path we are testing is individual stocks. This is what most people dream of when they think about investing. You buy a piece of a company you love, and you hope it becomes the next tech giant. It feels exciting. It feels like you are a real player in the game of business. But let us be honest about the learning curve. It is high, very high. To succeed here, it is not enough to just pick a brand you recognize. You have to become a financial detective. You need to dig into income statements, analyze balance sheets, and scrutinize cash flow reports. If you are buying stocks just because you like the logo, you aren't investing, you are guessing. And the market usually punishes gamblers. Regarding passive income potential, the situation is actually quite good. When you own a stock, there are 2 ways you can make money. First, the price goes up and you sell for a profit. Second, you can receive dividends. Dividends are regular cash payments made by a company to its shareholders. It is essentially money hitting your account while you sleep, without you having to sell a single share. Not all companies pay them, but the ones that do can be a goldmine. What about tax efficiency? This is where the pros separate themselves from the amateurs. If you use the right tax-advantaged accounts, you can shield your profits from the tax man. If you ignore this, you are leaving free money on the table. But be warned, every country has different rules. Individual stocks are powerful, but they carry heavy risks. Let us look at why that is. Now, let us talk about risk. This is the part that most get-rich-quick videos conveniently skip over. When you put your hard-earned $100 into a single stock, you aren't just betting on a company, you are betting on their management, their supply chain, their market competition, and even the global economy. If you get lucky, your investment doubles. If you get unlucky, your investment vanishes. I remember back in the late 90s, during the dot-com bubble, I thought I was a genius. I picked a few tech stocks, watched them skyrocket, and felt invincible. I thought the market would go up forever, but then the bubble burst. Companies that seemed solid one day were bankrupt the next. Those little $100 investments, they turned into $5 overnight. That is the reality of individual stock picking. You can mitigate this risk by using demo accounts, paper trading with fake money before you ever put a real cent on the table. This allows you to test your strategy without the emotional pain of losing your capital. You have to learn how to read income statements and balance sheets. If you don't know what a debt-to-equity ratio is, you are simply throwing darts at a board while blindfolded. The lesson here is simple. Individual stocks offer the highest potential growth, but they also carry the highest probability of total loss. Do you have the stomach to watch your portfolio drop by 30% in a single week and stay calm? If not, then individual stocks might not be your primary path. We have more ways to invest, and some of them are much more stable. Now, let us step into the world of real estate. Most people think investing in property requires a massive down payment, a mortgage, and endless phone calls with tenants at 3 in the morning. That is not the case anymore. Enter the Real Estate Investment Trust, or a REIT. Think of it like this. Imagine 3,000 people pool their money together. They collect $300,000, buy a massive commercial building, and then split the rental income among all 3,000 of those people. That is exactly how a REIT works. You own a tiny slice of the front door, a slice of the window, and a slice of the bricks. You get all the benefits of being a landlord without ever having to unclog a toilet or chase down late rent payments. The learning curve here is moderate. You don't need to be an expert in building codes or local zoning laws. You just need to understand what the REIT owns. Do they own office buildings, shopping centers, luxury apartments, hotels? Each one carries different risks and rewards. For passive income, this is arguably the king of the grid. By law, in many jurisdictions, REITs are required to distribute at least 90% of their taxable income back to their shareholders. This isn't just a promise, it has a legal mandate. This means that if the property is rented out and profitable, you are almost guaranteed a steady stream of dividends. It is stable, it is reliable, and it provides cash flow that individual stocks often struggle to maintain during market downturns. But wait, is it risk-free? Not at all. Let us talk about what happens when the real estate market decides to take a nosedive. So, we've covered the basics of REITs. It sounds perfect. You get paid rent, you don't have to deal with broken pipes, and the dividends are often substantial. But now, we have to look at the ugly side of things, the risk. Think back to the last major economic crisis, when the world shuts down and businesses can't pay their rent. Who pays the price? The REITs. Even if you own a tiny, fractional share of a massive skyscraper, if that building sits empty, you aren't getting paid. The value of your investment drops, and the dividends you were relying on can be slashed or eliminated entirely. My personal experience with REITs over the last 4 years shows exactly why this is a medium-risk investment. I put $100 into a commercial property trust, and honestly, the performance wasn't a rocket ship. It was slow, it was steady, it actually took a small dip because the commercial real estate sector struggled to recover from global lockdowns. However, I didn't lose my shirt. Why? Because while the value of the shares dropped slightly, the dividends kept trickling in. That's the power of REITs. They aren't meant to be overnight sensations. They aren't designed to make you a millionaire in a month. They are designed to be boring, consistent, and reliable. If you are looking for a get-rich-quick scheme, you will hate REITs. But if you are looking for a way to build a foundation that slowly accumulates wealth, this is a vital piece of the puzzle. Now, what happens when we move away from buildings and stocks and into something entirely digital? Let us talk about the wild frontier, cryptocurrency. Now, we enter the most controversial and explosive part of our experiment, cryptocurrency. Forget banks, forget governments, and forget traditional financial institutions. We are talking about digital money that runs on something called blockchain technology, a system that is inherently secure, transparent, and almost impossible to fake. Some people call it digital gold, others call it the biggest bubble in modern history. I call it part investment, part speculation, and absolutely not for the faint of heart. The learning curve here is moderate, but the barrier is technical. You need to understand how to store your assets. You aren't just buying a stock that sits in a brokerage account. You are taking control of your own digital wallet. If you lose your keys, you lose your money. There is no customer support line to call, no bank manager to fix your mistake. It is absolute personal responsibility. Passive income in crypto is a whole different beast. Unlike stocks or REITs, coins don't naturally pay dividends. However, we have techniques like staking, where you lock up your tokens to help secure the network in exchange for rewards, and yield farming, which is essentially lending your crypto to others for interest. It sounds amazing, right? But here is the catch: if the platform you are using gets hacked, or if the project itself is a scam, your income doesn't just drop, it evaporates completely. That is why I personally stick to the giants, like Bitcoin and Ethereum, and keep them on an offline hardware wallet. Crypto is high risk and high reward in its purest form. If you want to see your $100 potentially soar or crater, this is where it happens. Are you ready to see the results of my own 4-year crypto experiment? 4 years ago, I took that same $100 and put it into Bitcoin. I did it through a popular, easy-to-use exchange, and then I did the most important thing of all, I walked away. I didn't check the price every hour, I didn't panic when the market dipped, and I certainly didn't try to trade the swings. Look at the result. That original $100 is now worth $652.24. That is a return of 552%. Now, before you get excited and decide to put your rent money into the next trending meme coin, I have to be brutally honest, this is not typical. Bitcoin has been the best performing asset of the last decade, but that doesn't mean it will continue to perform this way forever. Most cryptocurrencies don't see these kinds of returns. In fact, most of them lose their value entirely. This wasn't a result of skill, it was a result of picking a dominant asset and having the patience to hold it through the absolute madness of the crypto markets. People lose their fortunes in crypto every single day because they trade with emotion. They buy when the price is hitting record highs because of fear of missing out, and they sell at the very bottom because of panic. My experience shows that crypto is incredibly powerful, but it requires a stomach of steel. If you are going to jump into this world, do it with money you are prepared to lose. Research the projects, understand the technology, and for the love of your future, stay away from the get-rich-quick scams. Crypto is a tool, not a magic wand. We've seen the wild swings of tech stocks and the high-octane roller coaster of crypto. Now, let us talk about something entirely different. Let us talk about gold. Gold is the oldest, most trusted way to store wealth in human history. It isn't a digital code, it isn't a company with a CEO who can resign, and it isn't an asset that relies on internet uptime. It is a safe haven. When the economy is struggling, when inflation is eating away at the purchasing power of your dollar, or when global uncertainty hits the headlines, gold is where the world turns. The learning curve here is incredibly low. You have two main ways to start: physical gold or gold ETFs. Physical gold, like bars or coins, is tangible. You can hold it in your hand. But remember, if you buy jewelry, you are paying a massive markup for the craftsmanship, not the metal. I prefer gold coins, but then you have to deal with the headache of storage and security. On the other hand, we have gold ETFs. These allow you to buy shares in a fund that holds physical gold for you. It is quick, easy, and can be done with a few clicks on your phone. But here is the trade-off: passive income potential is exactly zero. Gold doesn't pay dividends, it doesn't pay interest. It doesn't create products, it just sits there. Its only job is to protect what you already have. It is a shield, not a sword. If you are looking for rapid growth, gold will frustrate you. But if you are looking for financial insurance, it is a classic that has survived every currency collapse in history. Gold is famous for its safety, but people often get caught off guard by the taxes. Most investors assume gold is taxed like a stock, but that is a dangerous mistake. In many countries, physical gold is classified as a collectible, not a financial asset. This means if you hold it for a long time and sell it for a profit, you might be looking at a higher tax rate than you expected, sometimes as high as 28%. However, there are ways to work around this. If you hold gold through specific exchange-traded funds, you might find more straightforward tax treatment. Or in some cases, you can shield those assets entirely by holding them within tax-advantaged accounts like an individual savings account in the United Kingdom or a Roth IRA in the United States. But always do your own research, because the taxman doesn't accept a YouTuber told me as a valid excuse for an underpayment. Now, let us look at my results. 4 years ago, I put $100 into a gold exchange-traded fund to see how it would handle the economic uncertainty we've seen lately. I clicked buy, and I became Mr. Goldman. Today, that same $100 investment is worth $140.10. That is a total return of 40.1%. Is that as exciting as the 500% return we saw with Bitcoin? Absolutely not, but look at the trajectory. It wasn't a wild, heart-stopping ride. It was steady, slow, and consistent growth. Gold didn't save me from poverty, but it didn't keep me up at night, either. It did exactly what it was supposed to do. It preserved and grew my wealth while everything else was fluctuating. If you remember only one thing from this entire video, let it be this: index funds. This is the foundation upon which the most successful investors on this planet build their empires. Imagine owning a tiny, fractional piece of every single company in the market: Apple, Microsoft, Amazon, and hundreds of others all at the same time. That is an index fund. You aren't betting on one winner, you are betting on the growth of the entire economy. The learning curve, it is practically zero. You don't need to read hundreds of financial reports, you don't need to stress over the latest corporate news or quarterly earnings. You buy a fund that tracks something like the Standard & Poor's 500, and you let the market do the heavy lifting for you. It is the definition of set it and forget it, passive income. It is moderate. While these funds don't usually pay the massive, high-yield dividends that some individual companies do, many of the underlying businesses within the fund pay dividends, which are either reinvested to fuel your growth or paid out as cash to you. Tax efficiency is excellent. In most developed tax systems, if you hold these in the right account like a stocks and shares ISA or a Roth IRA, you can watch your wealth compound tax-free for decades. That is a massive advantage over time. Risk. It is the lowest on our list because you are diversified across hundreds of companies. If one company fails, your portfolio doesn't crumble. You have hundreds of others to keep you afloat. Historically, this approach has delivered solid, double-digit returns over the long term. This is not a shortcut. This is the surest, most reliable path to financial freedom. We have tested them all. We've seen the highs and the lows, from the 552% return on Bitcoin to the steady, reliable growth of index funds. Here is the reality. There is no single best investment. Each of these 5 paths has a specific role to play in your financial future. Individual stocks are your high-growth engine, but they come with the risk of total loss. REITs are your income-generating machine, providing reliable cash flow. Crypto is your high-stakes bet on the future of technology. Gold is your insurance policy, keeping your wealth safe during the storms. And index funds, that is your backbone. That is the steady, compounding growth that builds true, generational wealth. Personally, index funds make up the majority of my portfolio, but I diversify across all of these areas to balance growth, stability, and risk. So, what should you do with your first $100? Don't wait for a better time. Don't wait until you have thousands of dollars. The biggest mistake you can make is waiting for perfection. You don't need to be a millionaire to act like one, you just need to be a person who starts today. Whether it is downloading an app to practice with a demo account, setting up an index fund, or buying your first fractional share, just do something. Time is your greatest asset. The power of compounding is a force that, given enough years, will turn that small $100 investment into a life-changing sum. You now have the map, you have the tools, the only thing left is to take the first step. If you want to know what the laziest way to make money online is, click the video right here, but do not just watch act. Subscribe, join the community, and let us grow this wealth together. I will see you in the next one.